Why asset building matters more than ever. The world is entering a new economic era. Rapid technological change, geopolitical uncertainty, artificial intelligence, demographic shifts, and climate challenges are reshaping how wealth is created and preserved. Traditional career paths are becoming less stable. Inflation continues to erode purchasing power, and financial literacy is no longer optional. It is essential. By 2026, owning assets will be far more important than simply earning income. Income is temporary. Assets are durable. Income depends on your time and effort, while assets work for you, even when you sleep. This video explores 7 critical types of assets you should aim to own by 2026. These assets go beyond money and include skills, systems, and ownership that create long-term security, leverage, and opportunity. This is not about becoming rich overnight. It is about building a resilient personal economy that can thrive in uncertainty. 1. Cash flow producing assets. Assets that generate income without active daily involvement. Cash flow is the lifeblood of financial freedom. In 2026, relying solely on a salary is risky. Automation, outsourcing, and AI continue to replace routine jobs, while economic shocks can disrupt entire industries. Cash flow producing assets provide predictable, recurring income, reducing dependence on any single employer or client. Examples: rental real estate, dividend-paying stocks, online businesses, e-commerce, SaaS, content websites, royalties from books, music, or intellectual property, private business equity, peer-to-peer lending. Why this asset matters in 2026. Inflation reduces the real value of savings. Job security is declining globally. Multiple income streams increase resilience. Passive or semi-passive income buys freedom of time. Key principle: don't work for money. Make money work for you. Action steps: start small. Invest in dividend ETFs or REITs. Learn one business model deeply instead of chasing many. Reinvest cash flow to compound growth. Cash flow gives you optionality, the power to make choices without fear. 2. Financial assets, stocks, bonds, and funds. Ownership in the global economy. Financial assets represent ownership in companies, governments, and productive systems. Despite volatility, they remain one of the most effective long-term wealth-building tools. By 2026, access to global markets will be easier than ever, but emotional discipline will matter more than technical skill. Core financial assets: stocks, individual and ETFs, bonds and bond funds, index funds, S&P 500, global indices, target date retirement funds. Why financial assets still matter. They scale without requiring more of your time. Historically outperformed inflation over long periods. Allow participation in global economic growth. Highly liquid compared to physical assets. Mistakes to avoid: trying to time the market, overtrading based on news, concentrating too heavily in one stock or sector. Winning strategy: dollar cost averaging, long-term holding, 10 to 30 years. Broad diversification, low fees. In 2026, the winners will not be the fastest traders, but the most patient owners. 3. Skills and knowledge assets. The most underrated and high-return asset. Skills are assets that cannot be stolen, inflated away, or automated easily, if chosen wisely. In the age of AI, generic skills lose value quickly. Rare, adaptive, and leverageable skills become priceless. High-value skills for 2026. Critical thinking and problem-solving. AI literacy and prompt engineering. Software development and automation. Sales, negotiation, and persuasion. Writing and communication. Data analysis and systems thinking. Leadership and decision-making. Why skills beat money. Skills generate income repeatedly. Skills travel across borders. Skills adapt to market changes. Skills compound through experience. Mindset shift. Your degree is not your asset. Your ability to learn is. Action steps: Invest at least 5 to 10 hours per week in learning. Build real projects, not just certificates. Teach or share knowledge to reinforce mastery. In 2026, learning velocity will matter more than credentials. 4. Digital assets and online presence. Ownership in the digital economy. Digital assets are properties that exist online but generate real-world value. They are scalable, borderless, and often low-cost to create. By 2026, digital ownership will be as important as physical ownership was in the past century. Types of digital assets. Personal brand, LinkedIn, YouTube, X, blogs. Websites and blogs. Email lists. Social media audiences. Domain names. Digital products, courses, ebooks, templates. NFTs and blockchain-based assets. With caution. Why digital assets matter. Near zero marginal cost. Global reach. Monetization flexibility. Strong leverage of time. Example. A blog post written once can generate traffic and income for years. Key rule. Rent platforms, but own your audience. Action steps. Build an email list early. Create valuable, evergreen content. Focus on one platform first, then expand. In 2026, your online footprint will influence your income, opportunities, and reputation. 5. Real assets, physical and inflation hedging assets, protection against uncertainty and currency erosion. Real assets have intrinsic value and often perform well during inflationary periods. They anchor wealth in the physical world. Examples: real estate, farmland, commodities, gold, silver, infrastructure investments, collectibles, art, rare items with expertise. Why real assets matter. Hedge against inflation. Provide tangible security. Lower correlation with financial markets. Often generate income or utility. Caution: real assets can be illiquid and require maintenance. They are best used as part of a diversified portfolio, not the whole strategy. 2026 Outlook. As governments increase debt and print money, scarcity-based assets may gain importance. 6. Network and social capital. Your relationships are assets. Your network can open doors that money cannot. Opportunities often come through people, not job boards. In 2026, collaboration will outperform competition. What is social capital? Trust, reputation, access to information, mutual support, high-leverage relationships, mentors, industry peers, builders and creators, investors and advisors. How to build it. Provide value before asking. Be consistent and reliable. Share opportunities generously. Maintain long-term thinking. Truth. Who you know matters, but who trusts you matters more. Social capital compounds quietly but powerfully. 7. Health and energy assets. The foundation of all other assets. Health is the ultimate non-negotiable asset. Without it, every other asset loses value. In 2026, mental health, physical energy, and emotional resilience will be competitive advantages. Key health assets: physical fitness, sleep quality, nutrition, mental clarity, stress management, emotional intelligence. Why health is an asset. Increases productivity, extends earning years, improves decision-making, enhances life enjoyment. Modern reality. Chronic stress and burnout are becoming normal, but they shouldn't be. Daily investments, regular exercise, digital boundaries, mindfulness or reflection, preventive healthcare. Your body and mind are the platform on which all wealth is built. Conclusion: building a balanced asset portfolio for 2026. The future belongs to those who own, not just earn. By 2026, the most resilient individuals will hold a diversified portfolio across 1. Cash flow producing assets. 2. Financial assets. 3. Skills and knowledge. 4. Digital assets. 5. Real assets. 6. Social capital. 7. Health and energy. You do not need to master all 7 at once. Start with 1. Build gradually. Think in decades, not months. Wealth is not about having more. It is about needing less and owning more of what matters. Thanks for watching. Don't forget to like and subscribe so you don't miss the next videos. See you soon.